All right, welcome back to another video. My name is Ian Major. I'm an entrepreneur, investor, and all-around raging capitalist. And in today's video, we're going to break down how did we get here and provide some historical context behind how we got to the monetary system that we all know today. And this is super, super important. This is not just kind of an academic topic, but one that impacts you and your wealth every single day. In the last video, I introduced the channel, went through a few kind of key concepts. So definitely be sure to check it out if you haven't already. I'll put a link down in the description below. But again, in today's video, we'll go through a little bit of history, starting with the 1870s. I can definitely do a future video on pre-1870, wherein there's quite a lot of fascinating information that we can learn from, as well as a few salient examples, whether it's the Roman Empire, Bourbon Empire, civilizations that have sort of fallen due to currency debasement, very similar to what we're seeing today. And so there's a lot we can learn from that. But as a crude oversimplification, you can imagine most societies pre-1870 as being on a kind of bimetallic standard, meaning, governments would recognize gold and silver coins. And this really stretches all the way back to 600 BC with, the kingdom of Lydia on the Aegean shores of Asia Minor with the invention of metallic coins for the very first time. So that's for another day. But how I want to kind of frame this up is with this very useful image, and a lot of the info I'm using for this video is coming from Winton, so definitely go check them out. They're an investment advisor. I thought they had put together quite a nice little summary here. And what you can see here is visually the percent of sort of nations or regimes that are adopting different monetary systems or currency systems across time. And so you can see between 1870 and the early 1900s, the story is really coming off of that bimetallic standard, going onto a gold standard. And so what was happening was Britain at the time, if we jump right into 1870, Britain at the time was the most productive nation on the planet, and it was on a gold standard, and so its trading partners naturally had an incentive to be on that same standard. So Germany followed a year after. U.S. followed a few years after that, and then you progressively had most of the nations in the world coming onto that same standard by 1900. And what was nice about this system are a few things. It has this self-regulating feature when it comes to the current account. So what you can see here in this kind of simplified diagram is starting with some current account state, whether it's a deficit or surplus. And as a reminder, current account basically captures the trading activity for a nation. So if you have a current account deficit, that means that you are importing more than you're exporting, right? So in that regard, you're consuming more than you're producing. And so net, as you can imagine, that would create an outflow of gold if you're paying for more than you are producing and selling. And so that leads to fewer value-backed currency units in that domestic market, which will naturally lead to lower prices and actual deflation. But that very same mechanism now suddenly makes your exports more competitive, right? Because they look more favorable to another nation, and conversely, it makes your imports now more expensive, right? And so that naturally will tip nations back towards the more of an equilibrium, and the current account status improves in that regards. Now, there's ways to hijack that. There's ways to accelerate that process without the actual kind of flow of gold, and that's through interest rate changes, which governments certainly do. And it goes in reverse with a current account surplus. This is a situation where you're producing and exporting more than you're consuming and importing, and naturally that would attract an inflow of gold, and the opposite happens. You have now more value-backed currency units. Prices increase, you get inflation, and that does the reverse. It now makes your exports less attractive, and it makes you more likely to import, since those would now be less expensive. So that's a nice kind of self-regulating feature. The other piece that's sort of built into this sound money type system is it naturally puts some caps around, reckless government spending, right? Because if I'm a government and I'm creating a whole bunch of new currency units to finance my war or whatever cause of the day might be, then there's going to be real pressure on my currency in relation to gold, which it's backed by, right? And so at some point, I need to produce enough value to commensurately cover, the new currency units that I'm sort of printing. And so these are a couple really nice features of a sound money system. Ultimately, the critics, kind of the big thing that they'll say is, well, that limits the amount that credit can be created, right? It limits credit growth, and it therefore limits, economic growth, or at least the pace of economic growth. And it's true to some extent, but I think the quality of growth matters an awful lot, right? And I think the whole, definition of what we've seen as fiat money has taken hold is lower and lower and lower quality growth, more and more and more artificial growth, right? Which has severe consequences. Even if the short and even medium term, you see, strong growth in kind of paper terms. So that kind of gets us to the early 1900s. Right before World War I, you have the creation of the Federal Reserve in the U.S. with the Federal Reserve Act of 1913. And I'll do a whole separate video on that. I mean, I could do an entire playlist series on this, and there's a lot of good content out there that goes really deep. This creature from Jekyll Isle, right? But it's interesting how it came about. You had the Panic of 1907. Which was quite a severe crisis, and at the time the government came to some of their rich banker buddies, including J.P. Morgan, who kind of summoned everyone into his mansion and was able to amass capital to back up the banks and and kind of soften the blow of this crisis, which led the government to ultimately agree to their proposal of having a central bank, which had been proposed all the way back, close to the founding of the United States, and for all that time had been swatted down by the population and by government broadly as well. And so not until 1913 did we have a central bank. And again, I'll go into that in a whole nother video because it really is a sort of disturbing tale. That we now have this entity that really fundamentally dictates the money system. And by the way, not a lot of people know this, but it has private shareholders, which are its member banks. And oh, by the way, they receive a 6% annual dividend on any profit that the Fed makes, in the course of a year. So it's a rabbit hole worth going down. But suffice it to say, you get the Federal Reserve, and then boom, 1914, World War I hits. And so all, the nations say, we're out. Let's pause the gold standard, basically, because we need to print money to fuel the war machine, right? And so that happens, World War I happens, and then post-World War I, nations try and kind of come back to the gold standard. Britain tries to come back at the pre-war level, which, France came back at a new level, and now there's all these trade imbalances between nations and a lot of friction, basically trying to kind of get back on it after they had not just left it, but left it in a dramatic way with a world war, in between in between that. And so the Rubicon at that point had been truly crossed, and there was really at that point arguably no coming back. But, Great Depression happens, World War II happens, and by this point we get to the end of World War II. The U.S. in the first half of the century had been incredibly productive, producing all sorts of goods and services, and you also had nations in Europe kind of stockpiling gold in the U.S. where they felt that it was safer versus in Europe during World War II. And so at the end of this Great War, the U.S. has this massive treasure trove of gold, by far the most gold out of any nation in the world. And so they kind of come to the table in Bretton Woods in New Hampshire, where kind of all the major powers came together, and the U.S. said, "Look, guys, look, I got an idea. What if all of you peg your currencies to the dollar, which in turn would be redeemable for gold at a rate of $35 per ounce? Not for private citizens, though, just for nations." So that's an interesting point. And at that same time, you had intergovernmental agencies or entities such as the IMF, such as the what's now called the World Bank, who would sort of stand ready to provide credit if another massive crisis came and all this stuff. And so, okay, you've got this system now where currencies are pegged to the dollar, dollars pegged to gold. But at that point, you now fundamentally have a rising centrality of the U.S. dollar in the global money system. Nations would want to attract and stockpile dollars in the same way that they're stockpiling gold in their reserves. And so therein starts this profound explosion of American overconsumption, right? Consuming beyond their means. By virtue of the U.S. dollar being the global reserve currency and U.S. treasuries being the fundamental reserve asset over time, and certainly post 1971, which we'll get to. And so what that means is that countries in Asia, in the Middle East, as you got further and further along, who have these savings gluts, who have saved up money, are now, basically exchanging that for dollars, because the U.S. has to export dollars to facilitate global trade, given that it's now this global reserve currency. And we'll talk about some of the implications of that over time. But basically, again, it just means that the U.S., by virtue of being able to just print money at will to export dollars as their main export to the world, and in return just consume at an exchange rate that otherwise wouldn't be the case if it wasn't the global reserve currency. It makes for a really, really interesting kind of dynamic that we'll go into. So now you get to the 1960s, and you've got the Vietnam War, you've got Lyndon Johnson's Great Society initiatives, you've got these really big spending bombs, right? And at this time, nations are kind of looking at the U.S. saying, "Whoa, guys, I don't really feel comfortable with your promise of converting U.S. dollars into gold. You're kind of creating all these currency units. You're spending in a reckless manner." And so nations one by one start to get a little bit nervous. You start to see, some nations trading dollars for Deutschmarks. And ultimately, fast forward to 1971, and things are really coming to a head. The U.S. has overconsumed, overspent, and at this point, nations are becoming really worried. And in 1971, you basically had more dollars than were supported by the U.S. Gold reserves. And so now it's a real issue. And now you've got nations coming to the U.S. to exchange their dollars for gold. And in August of 1971, President Nixon at the time, unilaterally delinks the dollar from gold, right? I mean, just boom, just like that. So the gold window's closed in 1971, and that's really the start of the current paradigm that we're in. This floating world in which some currencies are still pegged to the dollar, of course. Others are floating, but the dollar is floating. The dollar is floating in relation to gold, and we've seen what we've seen. I'll throw up another chart here. What has happened in terms of the gold price since that time. And there have been some modest kind of ups and downs. You basically had inflation in the 70s in the U.S. Volcker came in, jacked up interest rates to unprecedented levels to quell inflation. But by doing that, he made the U.S. dollar incredibly strong to the point where it got too strong to where it was being prohibitive for world trade. So you had the Plaza Accord of 1985. So you've had some of these kind of perturbations since that point. But really, for the last 50 years, we've been in this paradigm of a kind of floating dollar king sort of world. And that's really interesting, right? It has so many implications. It's allowed the U.S. to run these massive trade imbalances and consume, beyond our means for some time. And in doing that, it's hollowed out the manufacturing base in the U.S. And so therefore, it's also created a lot of this kind of political instability that you've seen grow over the last few decades. We'll probably do a standalone deep dive into the website WTFHappenedIn1971.com. But it's a fantastic view. I think I mentioned it in the last video, into a series of different charts and graphs that quantify how the world has changed since 1971. And it's fascinating the number of ills and challenges that ultimately are because of the monetary system we now find ourselves in. So I'm going to leave this video here for now. So to recap, right, and I'll throw back up our handy kind of guide. In the 1870s through the early 1900s, you really had a gold standard that provided this kind of self-regulating couple of features in terms of trade, in terms of putting a cap on kind of reckless government spending, and those are merits that I just don't think you can possibly ignore. The critics came and said, well, this limits credit growth and therefore economic growth. But again, as we're going to see in future videos, it's really the quality of growth that matters at the end of the day over the long run. You then had a couple world wars, ending with the Bretton Woods agreement, in which other currencies are being pegged to the U.S., which in turn is being pegged to gold, and that government just can't help itself, right? It can't help itself. And so it's going to spend more and more and more and more. The snowball had started. And by 1971, when there were more dollars out there than could be supported by the U.S.'s supply of gold reserves, Nixon unilaterally, and he said at the time, by the way, which is very interesting, we're temporarily doing this, which is, of course, a complete lie, complete laughable lie. And since then, you've had the dollar hegemony, the dollar regime. The dollar has reigned king, and you're starting to see a lot of really interesting dynamics where countries like Russia, China are stocking up on gold. You have countries in the Gulf, kind of moving in the same direction, and so it's going to be really interesting to see. But that's that for now. I hope you enjoyed this content. If you did, give it a like. Go ahead and subscribe. Leave a comment down below for future topics that you'd like to see covered. In the next video, I'm going to plan to go deeper into the nature of inflation and what it means for your wealth, because really that is the single key feature and characteristic of the system that we now find ourselves in, and it has nefarious implications, as you will rightly see. So until then, I bid you adieu, and I'll see you the next time.